Bob, what do you think is a good, let's say, a good benchmark to measure against when evaluating those managers in these different economic climates?
Yeah, well, I think of course you want to think about uh, their risk return. The amount of return that you're seeing relative to the amount of risk that's being taken,
Mhm.
and you want to see the type of risk that's being taken in the context of essentially a long only portfolio, whether it's stocks only or 60/40. And so when you think about something like the risk versus return, I think it's actually a very interesting one because some of the things that you can see in that are whether someone is basically just has outsized returns as a function of outsized risk taking,
Mhm.
which creates concerns that maybe, if the market went against whatever their bias is, they could experience substantial losses. What it also tells you is the plausibility that the returns that have been observed will likely continue. There's a lot of people, both in back tests, but also in reported returns, that may tell you that they have, very, very extremely good risk return ratios. Risk return ratios, Sharp ratios of 2 or 3 or 5. Such returns relative to risk are unlikely to be persistent over long periods of time, and may actually too good an outcome may reflect too much luck being a driver,
Right.
or in the extreme may raise questions about the validity of the return profile that you're seeing either in reported returns or a back test. And
Mhm.
so you want to, it's almost like what you want to do on the risk return thing is you want someone who has who's giving you a plausible risk return, not someone who's giving you a bad one or a particularly good one. And then on correlation, it's just simply a question of, when you're building your whole portfolio, obviously the more that someone is simply taking risk that otherwise exists in your portfolio. So, for instance, if you're, have a lot of equity beta, you may not actually want that because you're like, look, I got plenty of equity beta. I don't need to pay for it. It's free. Let me just, buy SPY or VTI or something like that,
Mhm.
versus managers that have lower correlation to the assets that are already in your portfolio. I think the key trade-off there is that you have to understand that there's a trade-off between those two things, which is that often to get lower correlation, you actually have to have worse risk relative to or return relative to risk. And that when you start to see people say, I have essentially a zero correlation and I have outsized Sharp ratios, that should raise questions about the plausibility of that strategy, and whether it is likely to achieve those sorts of outcomes that are at least being pitched to folks.
Mhm.